Welcome back to the weekly Market Insight broadcast. I'm John Gatewood, founder and CEO of Gatewood Wealth Solutions, and I'm with Aaron Tuttle, our Chief Investment Officer. Welcome back, Aaron.
John, it's good to be here.
Boy, it's been a busy time. We've had a lot of the earnings have been coming out.
Yeah.
The market keeps going up. I'm just wondering, when is it going to be coming back down? Interest rates are still coming back down.
That's right.
I was looking at a chart, in 2018, interest rates were 3%, and we thought that was really low.
Yeah, they weren't going lower.
I mean, how could they go lower than 3%? And now they're 2 percentage points below that now, which is incredible.
Yeah.
And but people are a little bit concerned. So let's get right into it, because
Sure,
there's a lot of things that you'll be able to answer to for our audience today.
So let's just jump to LPL has a great dashboard for the earnings. And it's a little bit dated. We've had a few more companies report since this was screen grabbed. But we had 297 of the 500 companies that have reported in. Out of that, 88% of them have beat their earnings expectations or their revenue expectations, and 87 therefore have beat their earnings expectations.
That's significant.
It is significant.
When's the last time you think that happened?
I think it was 2008, 2009.
Wow.
But we actually expected to not have as high a beat rate, because we've had a couple of quarters with beat rates, and really it's known as the base effect. You're coming off of a year ago's quarter, so people are kind of still with that pessimistic view when they're estimating. But this is significant growth, so much so that we have revenue growth of 23.1%. Well, that starts to explain why the market has been up, is because of the growth rate on earnings, because that is the way you value companies, is the growth of the earnings that they have. So earnings per share is actually up 85.2% whenever we're looking at it. So really, really good news there. If we look at forward earnings, we're at about 204, and if people remember the call that Chris and I went over, that's right in line with where we expected forward earnings to go, and we still have, it's projecting out 4 quarters, right? So next quarter, that 4 quarters out, so long as we have growth, would continue to increase. So all good news on the earnings front.
But is that sustainable? I mean, that's the question. And
right?
Will that, is the market at a point where we could actually go back and do a little bit of retracement just because
absolutely.
of the high earnings?
To earnings are historical, right? And you don't invest in the rear view mirror. It's always about what is going forward. And then when we look at just the seasonality, we had mentioned last month in July that July was actually a good month, that most of the time it actually had, it appreciated in value. I think it was 100% for the NASDAQ.
Yeah.
And August is not such a good month whenever we look at the seasonality. It's actually August, September, October are the rough months historically.
And October has had the steepest decline in history, or at least since 1987, correct?
And we talk about our money supply indicator, and we're going to get into our money supply indicator on this call, but we think that is part of the reason that things show up in October, is because there's a seasonality to money supply. And August, September, October is whenever we start to see a downtrend in the growth of money supply. Now, most economists will actually adjust that seasonality out. We do not, because we think it's like dressing for the weather. On average, if we adjusted the seasonality, it would be like 60 degrees here all year round.
Right, exactly.
It definitely gets colder than that, and it definitely gets warmer than that.
Yeah, generally I want a coat in January and February.
Right, you do. You don't want to wear the parka in August, and you certainly don't want to be in your swim trunks in January or February. So this is concerning. And also, if you look at August, it's one of the lower months whenever you look at the maximum, minimum return. So down 14%, up 7%. And you can look out to October. October has the lowest minimum historical return of 21.76%. So we're getting into that time frame. We're a little bit more cautious. And we have not had a pullback. So this is a Goldman Sachs chart, and what we're looking at is how many days has gone by since the last 5% pullback in the S&P 500. Now, this screen image is a little bit dated too. At the time, we had 184 days. The average is 97 days.
So we're double the average.
Technically, we are absolutely due. Now, there are time frames where we have 400 days of continuous. Just because we're above average doesn't mean that it's going to happen tomorrow. But historically speaking, we are due for a correction. So what could cause that correction? Well, obviously, one thing that's capturing the headlines are the coronavirus cases, the Delta variant, and all the other components. And we have been seeing an increase in the amount of cases. We reviewed that last week. We have not seen an increase that's significant as of yet for the amount of deaths. There's a lot of therapeutics that are out there, and we know more about the disease, and a lot of the people that early on died, we actually have a stronger, more robust population because it's unfortunate that whenever a pandemic happens, a lot of the early deaths are high because there are a lot of people that are already borderline, and that's the straw that breaks the camel's back.
Well, what's amazing is that the deaths, the number of deaths is still not more than what it was early March of 2020.
Right.
So that's how well we've been able to heal people and take care of people, as you mentioned.
But there are places that are mandating masks. There are even places that are considering lockdowns. A lot of that seems to be more political than really data-driven. But politics are something that can affect markets. And if we were to have a lockdown, the market, I would say, is kind of backing off the probability of that happening. We're certainly going to see an impact to markets if that was to
so let's hope that there's not a lockdown that would be as damaging to the economy as what happened before, just because that would hurt everybody's portfolios for certainly in the interim.
And I think we can say, and I think people will argue, well, it's like, who would have known what would have happened if we didn't do the lockdown? But clearly the lockdown didn't work if we're still dealing with these problems. It's not an effective tool. It may have flattened the curve. Maybe we prevented some ICU deaths because we didn't hit capacity, but it can't be a long-term solution because we're still dealing with it, right? So that didn't solve the problem. And then if we look at overseas, which China is now dealing with another wave of the virus, but they have been cracking down on a lot of their technology companies. We talked about many months ago Jack Ma and how they were coming after him. He went into hiding. We now have Didi. I don't know if I'm pronouncing that correctly or not, but it's basically the Uber in China. And there's a lot of issues with the IPO that came up in their crackdown. They're cracking down on education due to prices, which is kind of backwards from Econ 101, right? You increase the supply of education providers, you should see a decrease in the cost.
Well, the problem then is that the emerging markets are underperforming because of things like this.
China specifically, and then just recently, Tencent, which is a big game developer, had put curbs on the amount of time children can spend playing video games, 1 hour a day, 2 hours on holiday, based off of a survey that probably isn't very scientific, and they're using a lot of language that is historically relevant, basically saying this is the opium for children. If you remember when the United Kingdom was part of China and was occupying, there was an opium trade and an opium epidemic, so they're kind of using that language of saying this is a historical problem. So a lot of things going on in China.
So how does this look today relative to, let's say, last month, last quarter? Because I know that you're working on a dashboard with the investment committee to understand what are those variables that impact our view about the market, and are we going to have a correction? Are we going to have an expansion?
Right, so we want to remove the noise of headlines. They're always there. We talk about climbing the wall of worry and try to get the data. Now, we haven't fully scaled this, so this is not calibrated to this is important yet or not, but I think this captures the direction that we're starting to see and why we are becoming a little bit more cautionary on the market, especially being the time frame that we're moving in, August, September, October. So we're always going to be looking 1 month back. So in July, we were looking at June 2021.
Okay.
And this is our spider graph to kind of look at several points within the market that we think are key to telling us whether there's a high or lower probability of having a market pullback, correction, or sell-off. And money supply yield curve, we've talked about, we're going to get into that. Bullish percent index is basically looking at how many companies are making new highs and doing well versus how many companies are not doing well and making new lows. So it's just a kind of a broad gauge of how the companies are doing underneath the index. And then we have consumer spending, we have housing, manufacturing, transportation, and employment. And most of these were very positive whenever we were looking back in the month of July. That's not the case, if I can get the slide to move forward.
So today then, what are the things that are deteriorating on your graph, on your spider
most
graph?
of the areas have actually moved into our circle. Now, remember, this has not been calibrated yet. So there's going to be a lot of back testing to get this calibrated
Right.
that we're doing. And we have the research computer really working on that to get this right size. But once again, the direction is something that we're noticing. So money supply has been declining, and the yield curve is still positive, which is good news, but it's certainly lower than it was last month because interest rates continue to decrease. That bullish percent index,
Yeah.
there's not as many companies making highs relative to lows as there were last month. Consumer spending has been down. Housing is still positive. Manufacturing is still positive. Transportation's basically where it was, and remember we have a lot of supply chain bottlenecks in the transportation area, specifically labor related, and then employment and the recession probability. My guess is the recession probability is going to be one of the last indicators to drop. But we're starting to see this and say there is reason to have caution here. We are not making trades at the moment to become defensive, and we don't know that we really need to. I'll get into the kind of the positions we've been taking, but know that we are starting to see some warning lights flash on our dashboard that say...
Should we be raising more cash for clients?
Remember last quarter, instead of spending down the cash bucket, we refilled it.
Okay.
And that means we have 30 months. So we're well past the next election before we need to access investments to meet cash needs. So we feel that we have a good cash buffer, and a lot of this is just starting to see the data slow down, see market valuations on where they were. Earnings are great. You can make a good reason why they're there, but we're starting to see some problematic data.
How would we become more defensive then, or what types of things would we do, and especially with interest rates as low as they are, it's almost non-defensive. I mean, at least it might keep the value of the portfolio as less volatile, but you're not making anything on money.
It used to be that whenever you wanted to be defensive, you went to stocks like utilities and consumer staples. But over the last decade, that has not been the case. The place that has held up well on a market sell-off has actually been on the growth side. And a lot of that is probably to do with how low interest rates are, and also technology is the rapid growth area, whether that's during a recession where you're trying to automate, trying to make things lean and reduce labor costs, or all of a sudden the economy's growing and you have all kinds of opportunities. But before we get there, let's look at this money supply, because I think this is important to understand the economists on one hand and on the other hand type of approach, because that's where we are with money supply.
We see the big spike from last year, of course.
So that parabola is not that we're in St. Louis, and we want to remind everyone that we're in St. Louis. That is the money supply growth of last year. So when we were seeing technical indicators saying to be more defensive, be more cash heavy, and we see a spike, now this is averaging out over a time period, so we could actually see the data it's important to be underneath the hood and see what was happening to the money supply. That's why we remained fully invested, and we're advocating our belief of a V-shaped recovery, was just how substantial the money supply growth was taking off. And it was very high to the point that we had to change the axis to actually track it, because it jumped so high. We got up to about 60% annualized growth rate whenever we were doing the numbers. That red line is the money supply now. That dotted line is the S&P 500. You can see basically they track together. And we've seen that historically that is the case. Money supply moves up, the S&P 500 moves up, and it's beginning to trend down. So we're looking at the growth rate. So now the growth rate is slowing. So that's giving us caution and pause. That's the one hand, that's the defensive component. But on the other hand, look how high it is. All those other squiggly lines down below are the last 5 years going back to 2015 of money supply growth. We still have very high money supply growth. It's just starting to slow. We think this slowing is the more important factor whenever it comes to market valuations. So we are looking at that yield curve. And we're beginning to see that, because if we see a yield curve that gets close to negative, getting almost to zero or close or negative, we're going to say that is a big indicator that the economy doesn't have enough cash relative to all the projects that they put in place when money supply was growing before, and we're going to need to clear those projects, and then we'll have a market sell-off. And the higher you are up in the production structure, the more you're going to sell off. So that's why it's always historically been you want to be in consumer staples, because those things are closer to the consumer than, let's say, a software development that's coming on that isn't even ready to go. It's still really early on in those stages. So we are starting to see some confirmation, but we still have a positive yield curve. So there may be enough money to continue with these projects, and we're just going to have a slowdown in the rate that the market is.
So it sounds like we could certainly have a sell-off here, or a correction even. I mean, it doesn't have to be a sell-off, but just let's say a 5 or 10% correction, but likely it would be short-lived, simply because there's still a lot of money in the system.
And what we didn't put up there is one of the concerns, but it is a concern, is just the infrastructure bills and the government spending. If we were to have a market sell-off, that $3.5 trillion or the $750 billion bill, also the 1.25 that's up there, they're going to get pushed through. There's going to be a huge fiscal response. So it'll be short-lived. And one of the reasons that we're really cautious here is, on the one hand, we have a slow growth, but on the other hand, we have very high money growth relative to historical terms, and we're seeing inflation move at a very high rate. Going to cash, at least for long term, if we don't have that correction, could be detrimental. And we're seeing it whether it's energy or food items, the inflation is very, very high. So energy is up to about 10% annualized, where food and all other items are around that 5%. So it would be risky to take your equity positions off that tend to do better in more inflationary environments to go to bonds that are paying well under inflation. So here's the 10-year. So we're down at 1.2 at the time of this screen print, while inflation's at 5. And the lower you go on interest rate, the more risk, whenever rates do begin to move up, on the value of those bonds going down.
So given the fact that the rates are so low, and there's that risk to the value of the bonds with interest rates going up, because you can't go down much farther, or I guess you go negative, but likely not going to happen in this market environment where GDP is growing.
It could, but what's the benefit of going from 1 to a half or 0? You would see a spike, but then 3 to 4 to 5% is probably something that is going to happen over the long term. So is that risk really worth the reward? We don't think so. One place that we would go are floating rate. So what is floating rate? Well, short-term bonds, the reason that they don't have much interest rate is because 1, 2, 3 years, you're going to get your capital back and you can then reinvest. Well, floating rates are actually a shorter time period. They just reset their coupon rate quarterly or semi-annually based on some type of index, let's say the LIBOR. So they say, well, what is interest rates right now on LIBOR? We're going to move our coupon up to there. So that means they don't change prices either whenever interest rates move up or down. And right now, we don't think it's a good, you're getting compensated well for the credit risk that you're taking on. But if we were to have a correction, these bond prices are going to sell off, meaning that the coupon yield would reset, but the price of the bonds would go lower, so you could actually get a higher interest rate. A 5 to 7 to 8% rate would not be unexpected if we had a market correction in these high-yielding senior floating rate paper. So we would actually look to invest that money, because we'd then be able to get rates that are higher than what we're seeing on inflation. And remember, our mission is to help clients become and remain financially self-reliant. So that means we need to get a return that is higher than inflation, so that we're growing the value.
Because it's not the preservation of principal. If you're only looking at preserving your principal, you're going to be losing the value to inflation, especially if it's 5%. Holy cow, that's high.
So that's where we are in the market. We are making some changes. A lot of them have just been following the technicals. We'll continue to do some trades here. We do think growth wins out, but if the lockdown concerns come off, we may see a reversion to that reopening trade. But we think we're well positioned given all of these variables that we've talked about today in the portfolios.
Has anything changed in terms of our view about overweights and underweights?
There is a change, but we haven't made the trade yet, so I want to hold that for next week. But they'll see the trades coming through. Not a big change. So there's no theme here that has changed. We still think inflation risk is high. We still favor equities over fixed income, despite the cautionary concern that our dashboard is giving us. We definitely favor U.S. domestic markets. We just talked about what China is going through as the next biggest economy. There's a lot of unrest in Europe, and there's not a lot of growth there either, demographics or any of that. So we still favor the U.S. economy. If we were to look at regions to invest internationally, we'd probably be looking at Latin America, Mexico, especially as supply chains are likely to shift from China to Mexico, a closer area, while labor costs are still high domestically. But there's really not a good, compelling story, so we like being in the U.S. market right now. Cleanest dirty shirt in the closet. I think we've been saying that for 15 years now.
At least.
And it seems that they're all getting dirtier, but it's still the cleanest dirty shirt. Still favor technology at the moment, especially if we think there's a correction. We think that is going to hold up better, and it has done so over the last several corrections. When we look at price points, we have enough headlines here to say, yes, we're still climbing that wall of worry where the market continues to move up despite all the headlines and the belief that we're just the shoe's about ready to drop type of scenario. And if you look, it's been a trend line that's been growing at about 6% quarterly and has been there. Now, it's been very noisy and it's been dropping near that 50-day moving average. We can't say that that's out of the realm of possibility. Actually, I would say that probably likely that we'll see that again. A lot of money in investment accounts, though, as they are looking for entry points, so we don't think there would be a significant sell-off, barring some type of black swan type of event. But we would see it as a buying opportunity and a time to shift into a risk-on portfolio instead of being a little bit more neutral, which is where we are at the moment. We can see that in just the performance on the 1 week. Last week was a rough week for the growth side, but after a really good week the previous week, if we look quarter to date, growth is doing much better than the value side. Large caps doing much better than the small capitalized companies, and you can see that when you compare a large cap growth at 3.62 and small cap value at negative 5.06. So over 8 percentage points of difference in performance over the quarter between those two, and so much so that where at the end of last quarter value is way ahead of growth, we can see that growth is now ahead of value. So we have 18% versus 15% in value, but there's still a lot of performance over the year for small cap. When we look at it technically, small cap is what's known as consolidating. It doesn't look like there's a breakout, and we want to stay in that large cap area when we're looking at the technicals.
Yeah.
We still think that's the right play, especially long term. So
is there anything that we should be looking forward to this week in the market, or that we should be paying attention to that might affect our clients' portfolios?
We have a video that we posted with Jeremy Siegel on stocks for the long run, and I think there's a lot of good questions in there that they may find beneficial for the long-term strategy. And I hear that we're going to have some special guests coming up in a call that the clients may be interested. A lot of wisdom for these two special guests that are coming. But I'll keep it a
Fantastic.
secret.
Oh, well, we can't give everything away in one broadcast.
That's
but
right.
So thanks again for joining us today, everybody. As always, we're here to give you our data-driven perspective on the market and the economy so that you can be better informed about your portfolios and when you're making other financial decisions. So is there anything else that we should be telling our audience before they leave with
If they
regards
have any
to?
questions, reach out to the lead advisor on the number on the screen, or go to our website. You can always request an appointment to speak with anyone. We're also happy to discuss. I know there's a lot of movement in the markets, a lot of things to consider, and if you have questions or even want to bring something to our attention that maybe we're missing, we've had some help several times.
Yes, we have.
From clients and viewers whenever they were making us aware. It's a complex market.
It is a complex market. Well, thanks again for joining in, and we do look forward to having you back again next week.